Picture this, March 2020. The world stops moving. Markets collapse, screens bleed red, panic spreads from Wall Street trading floors to small-town bank offices. Liquidity vanishes. Confidence evaporates. Then, almost quietly, the Federal Reserve makes a historic move. For the first time ever, it announces it will buy corporate bonds. Not Treasury debt, not government-backed securities, private company debt. Trillions of dollars suddenly hang in the balance. Entire industries are about to be stabilized or abandoned. But the Fed doesn't run the program itself. It hands the operation to a single firm, BlackRock. And the fee? Zero. No payment, no commission. Free. When the most powerful asset manager on earth agrees to work for nothing, it's worth stopping to ask a simple question. What are they really buying? Because this isn't about money. It's about influence money can't purchase. This is The Dollar Historian, where we pull back the curtain on American finance, tracing dollars from creation to consequence, exposing the architects who shape wealth, power, and the future you inherit. Welcome. Let's rewind. BlackRock's dominance wasn't accidental. It was designed. 1988. Larry Fink has just survived a career-defining failure at First Boston. A $100 million loss tied to mortgage-backed securities. Most would retreat. Fink does the opposite. He draws a different conclusion. The future isn't about picking winning assets. It's about controlling risk itself. So he builds a firm that's part asset manager, part technology company. At its core sits a system called Aladdin. Asset, liability, debt, and derivative investment network. The name sounds technical. The impact is anything but. Aladdin doesn't just analyze portfolios. It models stress, fear, correlation, and collapse. It shows institutions how their holdings behave in crises before crises arrive. By 2026, Aladdin oversees roughly $21.6 trillion in assets. That's nearly double BlackRock's own reported $14 trillion. Over 240 banks, pension funds, insurers, and governments feed it data every day. Around 250 million trades flow through the system. Every position, every exposure. BlackRock sees the entire table while still playing its own hand. Fink's strategic brilliance was simple. Sell the risk tools first. Banks pay BlackRock to analyze their portfolios. In return, BlackRock learns exactly where those banks are vulnerable, overexposed, or about to move. It's financial poker with X-ray vision. Early clients are elite institutions. Growth is steady through the 1990s. Then the acquisitions begin. In 2006, Merrill Lynch's asset arm adds roughly $1 trillion. In 2009, Barclays Global Investors follows for $13.5 billion. With it comes iShares, exchange-traded funds. ETFs promise diversification, simplicity, and low fees. Buy one fund, own hundreds of companies. But there's a catch most investors never notice. The ETF provider votes the shares. That means BlackRock votes on behalf of millions of retirement accounts, pensions, and 401ks. Your money owns the stock. BlackRock controls the voice. Today, BlackRock, Vanguard, and State Street form the Big Three. Together, they are the largest shareholders in roughly 88% of S&P 500 companies. Airlines, banks, pharmaceutical giants, tech platforms. This is called common ownership. It sounds harmless. It isn't. When the same institutions own competing firms, competition softens. Airlines stop slashing prices. Drug companies slow innovation. Wages stagnate. Studies from Harvard, MIT, and the University of Michigan all point to the same outcome. Higher prices, less innovation, lower worker bargaining power. Between 2010 and 2018, U.S. airline fares rose about 23% while service quality declined. During that same period, institutional ownership nearly doubled. That isn't coincidence, that's incentive alignment. Take a breath here. Your pension helps fund this. Institutions invest your savings, then bid against you in the real economy. Which brings us to housing. After the 2008 crash, BlackRock spots an opportunity. Not office towers, single-family homes. They pioneer single-family rental securitization. Houses bundled into bonds sold to investors. At first, it's niche. Then 2020 arrives. Lockdowns, job losses, foreclosures looming. From April 2020 through December 2021, institutions buy roughly 574,000 homes, not to resell, to rent permanently. Invitation homes, American homes for rent. Progress Residential, their largest backers, BlackRock, Vanguard, State Street. In cities like Phoenix, Atlanta, Charlotte, and Jacksonville, institutions now control 20 to 40% of rental stock. Algorithms armed with unlimited capital routinely outbid families relying on mortgages. Homeownership among Americans under 40 has collapsed from about 43% in 2005 to roughly 37% today. The median first-time buyer is now around 40 years old. Wealth creation delayed by an entire generation. You rent homes owned by institutions managing your retirement savings. The loop closes. But BlackRock's reach doesn't stop with housing. Enter ESG, environmental, social, and governance investing. Larry Fink's annual letters to CEOs read less like commentary and more like policy guidance. 2021, climate risk is investment risk. 2022, capitalism must be reimagined. 2024, companies must serve stakeholders, not just shareholders. BlackRock votes shares to enforce these standards. Large corporations adapt easily. Exxon hires consultants. Tech giants expand compliance teams. Small businesses struggle. Family manufacturers drown in reporting costs. Barriers rise. Giants consolidate. And those giants are already institutionally owned. Meanwhile, the revolving door spins. BlackRock executives cycle through Treasury, the Federal Reserve, and the National Economic Council. In 2020, several Fed bond buying programs disproportionately supported BlackRock-managed ETFs. Not necessarily illegal, but when you're everywhere, conflicts stop being visible. Then there's Aladdin's hidden risk. Uniform systems create uniform behavior. In March 2020, models across the system flash danger at once. Everyone sells. Markets fall 34% in 3 weeks, the fastest crash in modern history. Then the Fed signals support. Everyone buys. Stability or synchronized fragility. BlackRock doesn't trade on insider information, but it does see flows, correlations, and positioning before execution. That kind of awareness moves markets. Pause again. The old promise of capitalism was simple. Work hard, own assets, build something lasting. Today, institutions sell access instead. Your money builds their infrastructure. You pay to use it. Infrastructure is next. BlackRock's funds target water systems, power grids, toll roads, and renewable energy. By 2023, stakes in water systems serving millions of Americans. By 2024, renewable infrastructure across multiple states. By 2025, toll road partnerships with cash-strapped governments. Public assets built with taxpayer money sold cheaply to private capital. Governments are drowning in debt. BlackRock offers immediate relief. In exchange, it collects fees indefinitely. You don't own civilization anymore. You subscribe to it. This isn't new. History has seen it before. Feudal Europe worked the same way. Peasants farmed land owned by nobles. Rent flowed upward. Mobility was limited. Capitalism disrupted that by spreading ownership. Farms, businesses, homes, assets passed down, not equal. But upward movement was possible. Now the ladder is being consolidated. 3 firms own the rungs. Global, unaccountable, permanent. The top 10% own nearly 90% of stocks. Returns concentrate, fees accumulate. Larry Fink's net worth exceeds $1 billion. You pay rent. The winners are clear. Large pensions, endowments, the ultra-wealthy invested in alternatives. The losers are quieter, young families priced out, small businesses regulated into extinction, retirees whose funds compete against their own children. The end game keeps expanding. Food production, ports, telecommunications, everything becomes financialized. You'll own nothing and be happy. A line dismissed as rhetoric, until it isn't. So what now? Start with awareness. Most people have never heard of BlackRock. Understand where your money sits. Reduce overexposure to funds you don't control. Prioritize direct ownership where possible. Assets that can't be endlessly packaged. Policy matters too. Antitrust enforcement, limits on institutional home buying, transparency around systems like Aladdin. But make no mistake, this is structural power. It won't unwind quietly. Empires don't collapse overnight. They erode slowly, so gradually that people adapt before they notice what's gone. Capitalism isn't disappearing, it's mutating. It looks familiar, but it feels feudal. BlackRock isn't evil, it's rational. It plays the game as designed. The problem is the game is no longer built for you. 14 trillion in assets, over 21 trillion monitored, unmatched access to policymakers. The question isn't what BlackRock will do. It's whether enough people notice what's already been done. This is the Dollar Historian, because dollars reveal truths power prefers to hide. Subscribe, share, and remember to own your history before it's rented.